Hello and welcome back to Pantry Talk Weekly, the show where we break down the biggest business news of the week. I'm Alec, and as always, I'm joined by my colleague Nikki. How was your week, Nikki?
It was a busy one, Alec. Great to be back. We're here to help our listeners, professionals learning business English, make sense of the headlines. We'll discuss the news using clear, everyday language and explain the key concepts as we go.
Exactly. Today, we've got three major stories on our agenda. First, we'll head to the United States to discuss some political drama surrounding the Federal Reserve.
Then we'll jet over to Japan, where the Nikkei 225 stock index has been smashing records. We'll explore what's driving that incredible performance.
And finally, we'll look at China's economy, which has reported a mind-boggling trade surplus for 2025. We'll unpack what that means and why it's so significant. Ready to dive in?
Let's do it. Our first story takes us to the U.S., where former President Trump has been making headlines with his comments about the Federal Reserve Chairman, Jerome Powell.
Right. He's publicly criticized Powell in the past for not lowering interest rates, even calling him incompetent. And recently, he said it's too early to say if he would fire him, which has made a lot of business leaders nervous.
And that brings up a really important concept in economics, Fed independence. So, Alec, for our listeners, why does it matter so much if the Federal Reserve is independent? What's the big deal?
That's the key question. The Federal Reserve, or the Fed, is the central bank of the United States. Its main job is to keep the economy stable. It does this by managing interest rates to control inflation and promote maximum employment.
Right, those are its main goals.
Exactly. And Fed independence means it should be able to make decisions based purely on economic data without pressure from politicians who might want a short-term economic boost to help them get reelected.
So it's about separating economics from day-to-day politics. What happens when that line gets blurry? How do political statements actually affect business confidence?
Well, it can really spook the markets. That's a term we use when investors get scared and start selling. They worry that political interference could lead to bad decisions, like cutting interest rates too quickly, which could cause inflation to skyrocket.
It creates uncertainty.
Precisely. Business leaders like JP Morgan CEO Jamie Dimon have warned about this. The fear is that it sends a sell America signal to global investors. They might sell the US dollar, government bonds, and stocks because they see more risk.
So basically, the independence of the central bank is like a pillar of economic stability. If that pillar looks shaky, the whole structure feels less safe for investors. And this isn't just theoretical. We've seen in other countries what happens when a central bank loses its independence. It can lead to hyperinflation and massive economic instability. So for global businesses, a predictable Fed is crucial for planning and investment.
That's a perfect way to put it. Now, speaking of markets reacting to news, let's shift our focus to Asia, an incredible story coming out of Japan where the Nikkei 225 stock index has surged to a record high.
A record high. That is huge news. The Japanese market has been stagnant for decades. Why is it reacting this way now? What's driving this big rally?
It seems to be a combination of a few factors. First, there's political news. There are reports that Prime Minister Sanae Takaichi might call a snap election. That's an election held earlier than scheduled. It's a fantastic question, Nikki, especially for anyone who has followed the Japanese economy. For about 3 decades, from the early 1990s, Japan experienced a period of economic stagnation, often called the lost decades. The stock market was a symbol of that, remaining far below its 1989 peak. So this recent surge isn't just a small jump. It's a hugely symbolic moment, suggesting that Japan might finally be breaking out of that long slump.
Okay, and why would an early election make the stock market go up?
Investors believe it could lead to more government spending to win over voters. In business terms, that's called fiscal stimulus. The government pumping money into the economy often gives businesses a boost, which investors like.
That makes sense. More spending equals more economic activity. But I also heard that the Japanese yen has gotten weaker. How does that fit in?
That's the other major piece of the puzzle. A weaker yen is fantastic news for Japan's big exporters, like its famous car manufacturers. It makes their products cheaper for foreign buyers.
So a customer in the US or Europe can buy a Japanese car for fewer dollars or euros.
Exactly. It also increases the value of the profits these companies make overseas. When they convert their foreign earnings back into yen, they get more yen for their dollar, which looks great on their financial reports and boosts their stock price.
So we have positive political news and favorable currency exchange rates. Is there anything else?
Yes, one last thing is the influence of global markets. Wall Street in the US had a strong rally recently, and that positive market sentiment, or the general mood of investors, often spreads to other markets. Japan was essentially catching up to the global party.
It shows just how interconnected the global economy is. A good week on Wall Street can lift spirits all the way in Tokyo. What an interesting mix of factors.
Totally. All right, for our final story, we're staying in Asia, but shifting our attention to the region's economic giant, China.
Yes, and this is a big one. China reported a record trade surplus for 2025, reaching nearly 1.2 trillion US dollars. It's the first time it's ever crossed the $1 trillion mark.
That number is just massive. Let's break that down for our listeners. Mickey, what exactly is a trade surplus?
It's actually a very simple concept. A trade surplus happens when a country sells more goods and services to other countries than it buys from them. The value of its exports is greater than the value of its imports.
Like running a shop where you sell $1,000 worth of products, but only spend $200 on new inventory. You have a surplus of $800.
That's a perfect analogy. And what makes this record so significant is that it was achieved despite the tariffs the U.S. placed on Chinese goods. Many expected those tariffs to hurt China's exports badly.
So why didn't they? How did China manage to grow its surplus so much with those tariffs in place?
Well, China successfully shifted its focus. While exports to the U.S. may have slowed, they massively increased their exports to other parts of the world, like Southeast Asia, Africa, and Latin America. They diversified their customer base.
That's a smart strategic move, but is that the whole story?
Not quite. A trade surplus has two sides, exports and imports. The other reason the surplus is so large is because China's imports were weak. Their own domestic demand, meaning how much Chinese consumers and businesses were buying, was low.
So this is tied to the problems we hear about in their property crisis and overall consumer confidence.
Exactly. So while the huge surplus shows the power of China's export machine, it also highlights some weakness within its own economy. And on a global scale, it could lead to new tensions as other countries might complain that their markets are being flooded with low-priced Chinese goods.
That makes sense. It's a complex issue with both positive and negative sides. Well, that was a packed discussion. Let's do a quick wrap-up of the key takeaways from our three stories.
Exactly. This is where we might hear the term dumping. That's when a country exports goods at a price that is lower than the price in its own domestic market. It's a controversial practice because it can harm the industries in the importing country. With a surplus this large, we can expect more accusations of dumping leveled against Chinese companies.
Sounds good. From our first story, the key takeaway is that the independence of a central bank like the U.S. Federal Reserve is considered vital for economic stability. Political pressure can create uncertainty and scare away investors.
And from our second story on Japan, we learned that a stock market rally can be fueled by a mix of domestic factors, like hopes for government spending, and global factors, like a weaker currency and positive sentiment from other major markets.
And finally, with China, we saw that a massive trade surplus can be a sign of both incredible export strength and potential domestic economic weakness. It's a number that tells two different stories at once.
Great summary. And let's quickly review those three key business English expressions. First up was Fed independence.
That's the principle that a central bank should make decisions based on economic data, free from political pressure.
Next, a market rally.
That's a period of sustained increases in the prices of stocks or other assets. It's another way of saying the market is going up strongly.
And last, a trade surplus.
That's when a country's exports are worth more than its imports.
Perfect. We hope this discussion has been helpful for your business English practice. The best way to improve is to stay curious and keep following the news. That's all the time we have for this week's recap. Be sure to check out our daily Pantry Talk videos for more tips and vocabulary. Thanks for listening.
Bye for now.